Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. Wow. Didn't realize I had a frog in my throat. Hey, if you'd like to call us, 216-901-0945, just like the guy said. And as he mentioned, my name is Bill Bullington. I'm here every Saturday morning from 11 to noon. Also, you can catch this show on the Fish's website. It's 955thefish.com. It's available as a podcast. Or you can go to my website, Bullington Capital, and it's also hosted there as well as iTunes. So I'm not sure why anybody would want to do that, but it is available. And I think what I wanted to start off talking about today was the upcoming workshop that we're going to have. It's on Thursday night, September 20th. Got plenty of time. Thursday night, September 20th. It's going to be 6:30. It's Tri-Seas Corporate College. If you don't know where that is, just go to my website, click on the seminar tab. There's a map there. Very easy to get to. I really like that facility a lot. We're going to be talking about the highest rates of return that you can get on safe investments. And safe I put in quotation marks. Why did I do that? Well, because what one person considers safe is not often what other people consider safe. So we're going to have a discussion about the quote-unquote safe investments that you can make today and the rates of return that you can earn on them. Things like mortgage-backed securities, senior note bank loan funds. You want to stay away from, government-backed bonds that are more than 20 years in maturity. Bad idea. It's a really bad idea. In fact, the TLT, that's a government bond fund. It's down almost 6% this year. Okay, why is it down almost 6% when they're government bonds? Because the prices aren't guaranteed. The principal is guaranteed as long as you hang on to it until it matures. In the meantime, though, the price fluctuates quite a bit. So you've got these government-issued bonds that have lost nearly 6% of their value this year. And a lot of people thought that they were safe. So we're going to talk about that and how you can tell the difference between them, what types of rates of return you could expect. And because interest rates have gone up now, the safer, not completely safe, everything has some sort of risk to it. Even the short-term CDs have risk to them. We'll talk about what that is too. What most people consider risk is that, did I get my principal back? That's what most people consider risk. There are other types of risk that you can run into, especially with, like I said, quote unquote, safe investments. So we're going to be talking about that. We're going to explore those topics, the investments that you can make that may lose a little bit, but not a lot, but make up for it in the income that they're generating. That's kind of a key. That's a big key. So all this kind of stuff that people are generally looking for. How do I get the biggest bang for my buck, especially with my safe money? So the safe money. Again, you can go to the website, it's bullingtoncapital.com. You can sign up there for free. You can always call if you can't make the seminar. If you want to stop by, set up an appointment, talk about your situation, that's fine. You don't really have to go to a seminar to be able to do that. But oftentimes it's a lot more fun. Because at corporate college, it is really a nice facility there, incidentally. And they have 5-star chefs. In fact, I'm pretty sure they hired these people away from high-quality hotels, extremely high-quality hotels. Many of them have a training from the Ritz, which I think is kind of neat. Ritz-Carlton charges a whole lot of money to go to the Ritz-Carlton, and there's a reason for that. Because, in fact, they've even created their own urban myth, like the Ritz-Carlton treatment. That's the urban myth. And it's not really a myth. When you go into a Ritz-Carlton, I'm always impressed. I don't go there often. Let me say that right off the bat. I don't go there often. But the times that I have been there, they bend over backwards to do everything they can for you. You make a request, that person doesn't leave you hanging or say, well, go ask so-and-so and so-and-so. They say, come on. And they take you down and show you and introduce you to the people, explain your situation. That's the Ritz-Carlton treatment. And that's kind of what we try to do at Bullington Capital. We try to give you the Ritz-Carlton treatment, try to explain what we're doing. Our best clients and customers are people who understand the process, kind of like what I was talking about a little bit earlier. How do you get the highest rate of return on safe investments? Safe investments we're going to define as those that won't fluctuate a whole lot in value. Those that won't fluctuate a lot in value. Everything fluctuates a little bit, even a CD, by the way. The reason that people don't think CDs fluctuate is they typically hold them until maturity and then they're guaranteed to get their principal back. That's why they don't think that they fluctuate. But if you ever tried to sell that CD, oftentimes banks will have penalties, which means you could get back less than you paid for it. So even though it's a small risk, it's still a risk. Small risk, but risk. Realistically, investing is really all about managing risk. That's what you're really trying to do. You're trying to get the maximum amount of return that you can generate given the amount of risk that you're taking. Oftentimes, we all want the high returns, but nobody wants the risk. And one of the easiest things for someone to do who may not have your best interest at heart is to promise you those returns without the risk. And that just, it's not possible. So we like to show you what kinds of risks that you're taking. Like to do a lot of educational stuff. We'll be talking about the Bullington Capital Value because that kind of fits in with what we're talking about. The Bullington Capital Value model. We'll be talking about some new things we're doing. We're always doing something new. It's not a huge change, incidentally. The new stuff that we're doing, I think we're improving on our processes. We're always working to try to improve constantly. So is the industry, incidentally. The industry is constantly working, and it's improved significantly. I'm amazed. I'm actually amazed at how fast. I was also amazed at how long it took to get on the track that it's currently on. But once they decided to get on this track, it's been pretty quick. And I have to tell you, there's a firm called BlackRock out there. There's a firm called First Trust. These guys have been pushing the envelope. They've been pushing the developments. They've been coming out with the products that the other firms have to come out with a product to compete with. And they're kind of the market leaders. So we're going to be talking about how to utilize the research and the tools that they provide. Because when you're looking to increase the amount of safety that you have, you want to go with those companies that manage the most money in that space. Because they're generally, they generally have access to information that you probably won't. They have access to information that I won't have access to except through them. And it works out to be a really good thing. So you've got firms like Fidelity. They provide a lot of research, a lot of very helpful stuff. And the interesting thing to me anyway is that they're targeting people like my firm. They're literally going out and recruiting, hiring people to be concierges, to direct us when we have questions to the appropriate people in appropriate departments instead of going directly to the public. And that's a big departure. And I know why they're doing it. Because when you go directly to the public, you're dealing with people who don't have professional training, and it's a little more challenging. Actually, it's a lot more challenging. So it's interesting to me that all these years, I'm finally, that the type of business that I'm in is in the sweet spot. We're getting people rolling out the red carpet to try to help us help you. In fact, I need to get that clip from the movie with Tom Cruise. Help me. I think it is so funny. It's so perfect. It reminds me exactly of what's going on right now. So anyway, they're really doing a good job, and I really, really like the research I've seen coming out of these firms. It's it's so helpful. It used to be so difficult to acquire that kind of research, and now I just pick up the phone. It's amazing. It's amazing that you can do that. I get better research now than I did when I was a member of a huge, one of the largest brokerage firms in the country. I mean, the information I get is it's a lot better. There are lots of reasons for that, incidentally. It's been evolving over the years, and it's a really good thing. It's a really good thing. So you might want to check out that seminar. You can sign up for it online. It's free. No salesman will call. We have a really tough time calling back the people who want to talk to us. So we're not going to bother you. We're not low pressure. We are no pressure. That's the way my firm operates. So again, you can go sign up for that, or you can call up. You can set an appointment if you want to talk about certain things. Again, that seminar is going to be talking about the highest rate of return you can get on safe investments. Safe investments, those would be things like fixed income, government bonds, that type of thing. And there are big differences out there. The ones that have the highest yields are generally not the safest, particularly now. That at some point in time, the investments that have the highest interest rates are going to be the way to go. That time is not now. In fact, going that way right now can be really dangerous. You could end up losing a big chunk of your principal, or at least see the share prices drop significantly, which is a problem if you have to use that money. That can be a big problem. If you're going to be using that money for something and the share price drops, there's no mulligan. There's no do-over. Let me start back from the beginning. You're going to have to sell that at a lower price. That's what we're trying to avoid. Don't want to do that. I've got several ideas for you that can show you how to try to avoid that, if at all possible. And most of the time it is possible. The vast majority of the time it's possible. And so that's what we're going to be talking about. Highest rate of return you can get on safe investments. Have multiple options. Tell you which things to stay away from. And I have gotten a lot of questions, incidentally, lately on the Trump's policies towards trade. I shouldn't say Trump's because, he's not doing this on his own. There's a whole group of people. He's the one that takes the credit or the flack. It's kind of like a quarterback. Quarterback takes all the credit when they win, or actually doesn't take credit, is given a lot of the credit when they win. And when they lose, it's all his fault. Realistically, the offensive line is one that determines that. It's more of a team thing than it is one person. It always is. And that's kind of what, the president's role is really like a quarterback. Without a good offensive line and a good defense, you're not going to win very much. You don't have a good supporting cast, you're not going to do very well. So you could be the best president in the world and do horribly because you had a crappy Congress and a crappy Senate. But if you had a good Congress and a good Senate, you could be a pretty crappy quarterback and look pretty good. So don't really care much about that, and I can tell by the way the phones are lighting up. Those sports analogies are going over like a lead balloon. But the trade tariffs, is that really going to be that big of a deal? You've got to go read Trump's book, The Art of the Deal, first of all. Why now I hear the commercial starting. That means we got to take a real quick commercial break. You're listening to Bill Bullington right here on 1420. Stay tuned. I'll be right back.
Today we know that we are strong when we are weak. Today we trust, we overcome. Take every chain that kept us slaves and throw them off. We're not. It's easier to be the crowd, to just fit in and not stand out at all.
And we're back. Hey, you're listening to Bill Bullington. I'm here every Saturday morning from 11 to noon. You can also contact me if you'd like to. Go to my website, Bullington Capital. You can sign up for the upcoming seminar we're going to be talking about. And that's a long way out, by the way. It's September 20th. We're going to be talking about the highest rate of return that you can get on quote-unquote safe investments. Things like government bonds, senior bank loans, that kind of thing. Mainly income, dividend-paying stocks. We'll be talking about that as well. So sign up for that if you'd like to. There's no cost to attend. Seating is limited. I think we got 100 tickets there, and the place holds about 120. So I try to keep it so that people aren't sitting on top of each other, and that always works out pretty well, kind of. But anyway, if you'd like to send me a question for the radio program, that's fine too. Just send it to bill@bullingtoncapital.com. I'll try to talk about it if I have time on my show, and normally I do. Kind of like today, because nobody's calling. 216-901-0945, 216-901-0945 if you have a question. And, there's a lot of good news. There's a lot of really good news that's coming out of markets. I was just looking at the sector and industry data in the United States and the major sectors that make up the S&P 500, and I'm looking at the value of the stocks in those spaces. And I'm looking at the earnings yield, okay? Earnings yield is the opposite of the PE ratio. Now, I'm not sure why anybody ever started to look at actually, I am sure. See, there are these people that are walking amongst us that are called complicators. They love to make things much more complicated than they need to. Many of them end up in Congress. So the complicators came up with the whole concept of PE ratio. What is the price of the stock divided by the earnings, and low is good and high is bad, and you know what? Forget all that stuff. Earnings yield is a much better, it's the same thing, incidentally, but they're just talking about it in terms of, okay, if you got to keep all the profits and you paid whatever the stock is currently selling for, how much did you get? That's it. That's the earnings yield. And so now you can compare it to a CD. So let's say you got a stock, earned $1 a share. Let's say it earned $5 a share. They had $5 a share in profits after they took out all their expenses, paid all their taxes, $5 a share. And the stock was selling for $100. Okay. That would mean that the earnings yield is 5%. And I really think everybody ought to talk in terms of earnings yield. Why? Because you understand that. We all understand that much easier than we understand price to earnings ratio. So earnings yield is a big one. I got to take a real quick phone call. If you'd like to call 216-901-0945, and I got Paul on the line. Paul, what can we do?
Bill, how you doing?
Good.
Good. Hey, just want to touch base on, there's so much angst, and if you watch TV and cable news, you'd think literally that the world's coming to an end.
Mm-hmm.
And politically, I just want to see the psychology on people, clients, investing habits, just the psychology of how people feel confident when they make any investment with you or in the markets when all they hear about is one thing, but yet the economy and everything around you, like you alluded to earlier, is really kind of coming up roses.
Yeah. Well, I will tell you how I view that. I view that as a really positive thing. When the general public is giddy, kind of like they were in 1999, after 4.5 years of record-setting runs in the S&P 500, yeah. I'm a little worried. That's when I get worried. But as long as they're worried, I'm relaxed. So that's part of the contrarian in me. And it's just watching, human nature. And so, and I think those that are listening should probably take a little bit of solace in the fact that normally when everybody feels bad or they feel scared, the market does very well. And it would be great if their feelings were actually in tune with the way the markets actually worked. That would make everybody feel better, and you could actually you could time the market that way. But that's not actually the reality of it, and I know you probably know that. I know you do. I take a lot of. I don't say I don't take pleasure in it, but it makes me feel more comfortable if people are uncomfortable. When I get uncomfortable is when everybody just can't wait to get into the market. and your phone's ringing off the hook, and everybody went like, "Oh boy," uh-oh. and kind of like what I was talking about just a couple of seconds ago. If you look at the earnings yield, so I took the S&P 500 and I broke it down into the 11 major sectors. So the earnings yield on the basic materials is 7%. The earnings yield on the earnings yield on communication services is 11%. 11% earnings yield. Okay. The long-term average is 5%. That's the long-term average. So consumer cyclical is 5.2. The consumer defenses is 5.13. Energy is 6.79. Financial services is 9. I'm telling you, this market's got a long way to go. Now, when
Trump was out saying 4.1 is only the beginning, and if he works better trade deals, he basically said that we're going to start being able to pay off the $21 trillion in debt that we've accumulated, that we owe, and the economy grows at an 8 or 9% clip. He said we can literally pay the debt off in a very short period of time. Well,
if they didn't keep raising spending, which Congress has a tendency to do, despite whatever the president has said, they come up with all kinds of pet projects. Especially when GDP grows like that, the tax revenue automatically goes up. It automatically goes up. But see, the government's like a business. Their payroll, their salaries don't go up with that growth rate of the economy. It goes up slower. So what happens is the income coming in, it's going to go down and reduce that debt fairly substantially. And the faster the economy grows, the faster the debt gets paid down. So
I had an argument with one of my friends, actually, that tax cuts, he was adamant that they would cost the Treasury money, and I was adamant that tax cuts increase revenues to the Treasury, which I think I have been obviously proven very correct here in the last 9-10 months.
Well, there's a difference between correlation and causation. I would warn you on that one. But anyway, the only sector that's got less than a 4% earnings yield is technology. But I'm going to tell you, the growth rate is like 30-40%. So that could withstand that lower earnings yield. I think we're in great shape. I mean, I don't think we could be in better shape. I don't think we've been in as good a shape as this since the early 1980s.
Yeah, Reagan.
Yep.
Reagan years. All right, my friend. Thanks. Great show. Have a great day.
Yeah, you too. Thanks. If you got a phone call, question, or comment, 216-901-0945. Yeah, it makes me excited when I see that the earnings yield. Now, the earnings can drop. If earnings drop, then those earnings yields drop too. It goes down with it. So back to that example, if you had a company that was selling for $100 a share and it earned $5 in shares in profits after all expenses, the earnings yield's 5%. And incidentally, that's actually the long-term average of the 10-year Treasury, which is kind of the benchmark I like to use. So if the earnings yield is 5% or higher, then stocks are potentially undervalued, assuming that the economy doesn't go into recession. Okay. And, I think economists have successfully predicted about 10 of the last 2 recessions. I shouldn't be so hard on those guys. That was my major in college, by the way. That's why they call it the dismal science, incidentally. So anyway, you've got an earnings yield in some of these areas that is really, really high. The communication services kind of baffles me that it's so high. Actually, no, it doesn't really. It's because we've been growing so fast. And I've been talking about this thing called 5G. That's the next generation. You've got 4G now. 5G is so much more usable in so many different areas of the economy. It's not just cell phone and internet. It's cell phone, internet, cable television, the Internet of Things. Okay, when your refrigerator breaks and you're at work, you're going to get a text from your refrigerator saying, "Hey, your refrigerator is broken. Would you like me to contact somebody to come and fix me?" You're going to get that from your refrigerator. In fact, I'm sure some of them have that now. It's just not that common. So the cars that are driving themselves right now. And by the way, that technology, that is old. I remember when I was a kid, I wanted to be a pilot. I wanted to be a jet fighter pilot. And back then, when I was a kid, the F-16 was the bad boy in the neighborhood. The F-16 was the top dog. It had these instruments that actually projected up onto the windshield, so you didn't have to look down as a pilot because you were flying really fast. And the planes flew so fast that no human could react fast enough to fly that plane all by themselves. So it was assisted by a computer. Think about that. I don't know if you guys have seen me, but I'm kind of old. I'm not that old, 55. But back when I'm like 11, 12 years old, nobody had heard of computer-assisted anything. They didn't. Timex hadn't even brought out that first crappy home computer that they used to advertise all over before Apple decided to make those things. And so that technology is really, really old. It's old. I've got a lot of experience with it. They're just putting it into cars and trucks. That's all they're doing. And it's going to be a little bit different, obviously. It's actually going to be a lot better. So it's just amazing. All these things are coming, and it does. This reminds me of the early 80s. Big difference, though. One major difference. In the early 80s, interest rates were incredibly high. Some people paid as much as 22% on a mortgage. 22%. Can you imagine that? I mean, they paid that much for a mortgage. Interest rates were coming down during that time period. Interest rates were coming down. That was giving a big boost to the stock market for a whole number of different reasons. And we don't have, that part's missing. That part's different. This time, interest rates are probably going up. I don't know that they'll ever get to the level that they reached in the early 1980s. I kind of doubt it, especially with $12 or $13 trillion in interest-bearing debt that the government would have to pay. You raise the interest rates on average 1% across $12 trillion. That's, I think, what is that? 120 billion? Yeah, 120 billion. So 12 trillion, which is a trillion is 1,000 billion, by the way. So if you raised interest rates across the board 1%, that takes a while to do, incidentally. But if you did that, for every 1%, you're going to volunteer to pay an extra $120 billion in interest payments. Let me ask you a question. If you owed $12 trillion and you could set your own interest rate, what would you charge yourself? And you're not actually charging yourself, by the way. You can set the interest rate that others are allowed to charge you. What rate would you choose? I'd probably keep it pretty low. And I'm pretty sure that the president and Congress and Senate, they understand that. If rates go up a lot, then they're going to have to spend more money. They're going to have to cut other government projects to spend more money on interest, which they get nothing for. They pay out the interest. The public gets it does go into the economy, incidentally, so that interest will get spent. So at least some of it will get spent. Typically, most of it gets spent. Anyway, that's one of the reasons they call economics a dismal science, because one reaction causes multiple chain reactions, and it's really hard to figure out how exactly that's going to play out. In fact, nobody really does. They kind of have an idea, and then something happens and changes the whole projection or trajectory. And oftentimes it's not bad. Oftentimes it's just as good as it is bad. Sometimes you have some negative responses. Sometimes you have some really positive responses. And I think our caller, Paul, was pointing out that there are a lot of things that are really good. There are a lot of things that are really good. A trade war, what would that do? Yeah, that's what I've been hearing. What would a trade war do? By the way, when you are a client, we send out a newsletter about once a week. And it's really funny. We just started doing this a few weeks ago. It's really funny because I've had several calls saying, hey, did you read that thing you sent me? I'm like, who do you think is selecting those? Yes, I read the articles. I'm the one that's choosing the articles. So I'm sending stuff out that I think people might have an interest in. And we were talking about, I just picked out a couple on trade wars, what kind of impact that might have. I'm literally a couple minutes from a commercial break, so I don't want to start that topic. I'll wait until after the commercial break, and we'll talk a little bit about that in more detail. But I will tell you this. Trade wars, first of all, they haven't materialized yet. We got lots of time to negotiate. Now that I hear the music, I am going to hold that thought. You're listening to Bill Bullington right here on 1420 The Answer. I'll be right back.
There's a light filling this room where none would
And we're back. Hey, you're listening to Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420 The Answer. This show is also carried as a podcast on 955thefish.com and my website, bullingtoncapital.com, where you can also go and sign up for the seminar that's coming up here. And actually, it's quite a ways away. Now it's September 20th. But we're going to be talking about the highest rate of return that you can get on quote-unquote safe investments. And I think that's always an interesting topic. The safe, incidentally, is often defined by the person that's using that term. So we're really talking about things where you're going to have some sort of a guarantee on your principal. And we're also going to talk about, I always talk about various stock strategies. One of them is kind of similar to something we were talking about a little bit earlier on the show. We're talking about an earnings yield. And an earnings yield is just you take the earnings per share, that's the profits per share that a company earned over the last 12 months, and you divide it by the share price. It gives you a yield. So now you can compare it to a CD or a treasury. How neat is that? Well, I have a model that runs on something fairly similar to that. It looks at the income, it's actually earnings before interest and taxes. So it's a measure of cash flow. How much cash did the company generate before they paid taxes or before they paid interest on it? And there are some reasons that we use that. I think it's actually a little bit cleaner, and I'll explain that at the seminar, why we do it that way. But then we divide it by buying the entire business, the cost of buying all the business, instead of just the stock price. Why? Because a lot of companies have debt, and debt increases the risk. So this is a slightly more conservative way of valuing a company other than the price to earnings ratio or the earnings yield. It's a little bit more conservative. Okay, so I take that and I look at I narrow the list down to the 1,500 largest stocks by size. Okay, so I go take all the stocks that trade in the United States stock exchanges, the NASDAQ and New York Stock Exchange, basically those two. And I take the 1,500 largest, and then we look at the top 50 as far as the ones that have the highest cash yields based on that formula. Okay, so what am I doing? I'm trying to find those companies who are generating the most cash per dollar that I would be paying for the entire business. Now, you do that 1,500 times. You take the top 50 and you invest in them equally. And then every 6 months, you redo that. Now, I know people are out there saying, well, who in the heck is going to do that? Well, I am. That's why I talk about it. I think it's a very good strategy. A very good strategy for a portion of your money. Now, having said that, it's been running now for, close to 2 years. Very happy with the results. But I got to tell you, when you do that, you're buying stocks that have typically fallen over the past 12 months or so. They've typically come down. See, that's why the yield is higher. When the share price drops, the yields go up. Let's go back to the earnings yield example I was talking about earlier in today's show. $100 stock with $5 in earnings per share. That's 5%, right? The earnings yield is 5%. If the share price dropped to 50 because the market crashed for whatever reason, and the profits at this company did not drop, it's still $5 a share, and they're still on track to earn $5 a share, maybe even a little bit more. But let's keep it at 5 to keep the math simple. Let's say the stock goes all the way down to 50. You still have $5 in earnings per share, Now the yield is 10%. See how that works? When the share price comes down, the yield goes up. So what you're trying to do here is buy low and sell high. You're trying to buy stuff where the share prices have come down, who are generating a lot of cash. That's the basics. That's the basis of that whole strategy, and I like it. I call it the BCAP value model. But here's the thing. Some people got into it right away and then gave it about 6 months and said, I don't like this. I want out of it. I'm going to do something else. And that's common. That's pretty typical because they saw the long-term results of the back tests and didn't understand that, we're buying stocks that have been beaten down. They may not be done going down. I do not know that. No one knows that. In fact, there's at least a 50% chance that those stocks are still going to drop some more right after you buy, especially when I buy them. That's my luck. So they may not be done going down, and that can upset people. They think they're going to beat the market every day, every week, every month, every year. That's not going to happen. That's unrealistic. Nobody's ever done that. The most successful investor that ever lived has never done that. Think about that. The most successful investor that's ever lived has never done that. I'm talking about investors, okay? Because this is investing. It's not trading. There are some high-frequency trading firms that are allowed to take advantage of everybody else, and that's not the same thing. That's a whole different animal, and they don't let you invest with them anyway. That's for billionaires only. And they're finding it harder and harder to do because there are a lot of them. They're competing against each other, so their profits have dropped significantly from what they used to be, but they're still able to eke out a nice profit. Anyway, that's beside the point. So I've got this strategy. We'll talk a little bit about that too, because we're going to make that available. In fact, I've got a intern, goes to Case, and has decided he's probably going to study finance and economics. I think that's probably a good place to go. And he's going to put up a website. I'm going to provide him the data. And he's going to publish these models so that if you want to do this on your own, there's a firm that you can do this with. And that's one of my custodians. I use two. I use Fidelity and I use Folio Institutional. And at Folio, you can do this. You don't have to have a lot of money to do it either. So if something like that appeals to you, then by all means, you should do it. And since we were talking, the whole theme of this upcoming seminar are safer investments. Theoretically, it's safer to buy companies who are generating cash. I would think that is common sense. But I know that this is not taught in high school and a lot of college courses. I had 24 semester credit hours in finance, and they didn't teach this there. I'm hoping that they're teaching it now. I don't know whether they are or not. But to lower your risk, you want to concentrate on those companies that are generating a lot of cash. Now, I know some schools, they teach that. Columbia, I'm sure of that. That's where Warren Buffett got his master's degree. And I'm not sure why they don't all teach that. Actually, I have a suspicion, but anyway, it doesn't matter. We're here. We'll help you. I'll help you understand that process, understand how it works. I was having this conversation yesterday with my intern. Elite athletes, they do this thing called visualizing. In fact, I was being taught this by my Little League coaches when I was 9. They taught us the concept of visualizing, making yourself successful by mentally rehearsing what you were going to do when the pressure's really high. When you're in the middle of the game, it's a full count, you're standing at the plate, what are you going to do? You got 4th and 45, which is what we had one time. My Little League team, football team, we're expecting the coach to say punt. He comes in and says, flea flicker. He didn't say it. The kid that came in from the sideline that he gave the play to. Flea flicker. I don't know if you know what a flea flicker is. It's a triple reverse pass. Okay, these are a bunch of 9 to 12-year-olds. And you know what? Because we had practiced that so much, we got the first down plus an extra 2 yards. And if that guy hadn't been slow that caught the ball, it would have been a touchdown. So, But because we'd mentally rehearsed that, and because we had actually rehearsed it many, many, many times in practice, we ran that play, got the first down, and then some. So you need to do the same sort of thing with your investments. You really need to do that. But only if you want to be an above average investor. I mean, if you don't want to be above average, then don't do anything. Do the same thing everybody else does. Go chase performance. Look at the rearview mirror. Buy the things that just went up the most. And be upset when they drop like Facebook did yesterday, the day before. That's a tough way to go through life, especially when you're investing. But when you're investing, if you learn the proper techniques, like, by the way, you should see how sophisticated it is to do a triple reverse, the handoffs. You have to practice that. You have to mentally rehearse that a lot. Okay. And you're going to have to mentally rehearse your investing. What do I mean by that? You need to be able to stress test your portfolio, be able to figure out how much risk you think you're actually taking. How much risk am I taking? And it helps if you've got the kinds of tools that we have, that we can put those numbers in there, and I can show you. I can show you what it would have happened to your portfolio had you been invested that way during the big correction. So that way you can kind of adjust what you're doing to match your personality. If you see your portfolio in there and you see that, wow, that's a little bit too much of a decline, I don't think I want to put up with that, I can change the numbers and say, okay, wait, what if we did this? What if we put more money in the safer investments, a little bit less money in the more aggressive investments, the stocks? And this is what happened. Could you put up with that? You think you could put up with that? The more you can put up with, incidentally, the higher the returns you're going to generate. If you're not willing to take a fairly significant amount of risk, you just can't make a lot of money, especially today. The safer investments, they're getting better, they're improving, and they should improve a lot more over the next few years. But now that I hear the music, that means we'll have to wait till next week to pick up this conversation again. You're listening to Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420 The Answer. Have a good week, everybody. Good luck and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.